Hello, my name is Brett Walker. I'm an agribusiness specialist with the Excel Group. Today we're going to introduce to you a product called ECO. The Excel Group is a multi-location risk management agency located in Waverly, Cedar Falls, Cedar Rapids, Coralville, East Moline, and West Des Moines. We have a range of products that go anywhere from personal home and auto to commercial property casualty, employee benefits, and we have a wealth management division. So if you have needs for risk management products, we have them at the Excel Group. I'm going to introduce you to the agribusiness division. Myself, Molly, Mark, Renee, and in our property casualty sector, Andrew and Christine. If you have needs on the crop insurance or the property casualty side in the agribusiness world, we can help you. The Excel Group is a little bit unique in that we have our own in-house broker. Brant Heitman acts as a crop insurance agent and executes brokerage for our clients. Our main purpose of this video today is to introduce you to a new product called ECO, or Enhanced Coverage Option. I'm going to briefly walk through the history of crop insurance. So in the early 80s, the federal government brought out a yield-only policy, multi-peril crop insurance. That had some participation, and then in the mid-1990s, they introduced revenue protection items. You might remember CRC and RA. Then in about 2004, 2005, there was an emphasis to get more participation in these products, so the public enhanced that with a broader subsidy. That brought more participation. In the mid part of the last decade, 2014 and 15, you started to see more private products brought out to enhance the coverage of the base RP policies. So you might recognize some of those as being Arch, GAP, ICE, RPP, and some of you are familiar with these products. These are all unsubsidized products brought to us privately by carriers. So the public sector brought more coverage to us in about 2014 in the form of SCO. Now we're getting a product called ECO, or Enhanced Coverage Option, which is a fully subsidized product and a more broad spectrum. ECO allows you to go from 86 to 95% coverage on a subsidized product. You can choose a revenue base or just a yield-based policy. The design of this policy is to complement your underlying policy. So if you have a yield-only base policy, you're going to add yield-only ECO. If you have revenue-based, then you're going to have a revenue-based ECO policy. You cannot mix and match the two. They're going to be congruent with each other. If you have margin protection insurance or a county area-based policy, you are ineligible for ECO. And one thing to note, under these new policies, they are all driven off of RMA expected and actual county yields. This is slightly different than the past where we have used NAS data. If you'd like more discussion on that topic, be sure to give us a call and we can go in that in more detail. The basic components of ECO are going from 86 up to 90 or 95% coverage. The maximum amount that you can have is a 9% band of coverage in this policy. Coverage is generated on your personal APH. It's triggered on the county, but it's derived from your personal policy, and extends coverage from on-farm to more of an umbrella base. So think of this as a broad-based policy covering your entire farm. So these stacked examples will illustrate a little bit to you how this coverage looks. So if you have an 85% base policy, you can see that illustrated in blue. You now have a 15% deductible on top. You must stand the first 15% loss. The column 2 there, you'll see the same 85% base policy, a small deductible of 1%, because our ECO goes from 86 to 95%. So you have the gap of 85 to 86 with no coverage. And then you have a small 5% deductible on top. you'll see the ECO coverage in a 9% band illustrated in brown. The third column simply illustrates putting a slice of SCO into that coverage. Now we have completely filled that 1% gap, so we have 0 up to 95% coverage in this example. If you're wanting to save some premium and reallocate that premium to the top end of your coverage, you might drop your 85% base policy down to 80 or 75. In this example, we've dropped it to 75% coverage. So in blue, you have 75% RP coverage. You'll have an 11% gap from 75 to 86%. Then your ECO will take you from 86 to 95%, and then you have a 5% gap in the top. The fourth column represents leaving a gap in your coverage. So to save some premium, you've dropped from an 85% coverage policy to a 75% RP. You've left an 11% gap from 75 up to 86% and picked up your ECO coverage from 86 up to 95% coverage, and then a 5% deductible on top. So you essentially have a top end deductible and then a mid deductible in this example. Filling that mid deductible with an SCO policy. And you now have coverage from 0 up to 95%, coverage in this example with your 5% deductible on top. So how do the calculations work? We're going to use Bramer County as our example because that's our home base. So Farmer John lives in Bramer County and he has a 200 bushel APH. So as we noted before, we're going to calculate your coverage off of your APH. So in this case, we're using a $4.20 spring price. We multiply that times 200 bushels, which is Farmer John's APH. And we multiply that then by 9%, 86 up to 95%. That gives us $75.60 of coverage in our 9% band of ECO coverage. Farmer Bob, on the other hand, has a little better APH of 220 bushels. So we use the same spring price, calculate that times his APH, and in this example, you see that we get a higher coverage band of $83.16 in his 9% band. So again, the coverage is calculated off of your individual farm APH. So what does Farmer John's policy look like? As we previously stated, his coverage is $75.60 an acre. The expected county yield for Bramer County is 204.4 bushels. Multiply that by the same spring price of $4.20, and you get an expected revenue of $858.48. That's what our policy is going to trigger off of. So again, we start with Farmer John having his APH spring price to calculate his $75.60 of coverage. And in this example, we say we have a lower yield and a higher price. Generally, the two go hand in hand. You'll see our same Bramer County variables of 204 bushels times the spring price. And in this case, we had an actual yield of 190 bushels, but the price went to $5. Now, the 190 bushels, as I previously stated, is figured off of RMA data. So RMA derives their county yield information from actual county yields, not surveys. So we have to wait till May or June of the following year to get the RMA actual yield of 190 bushels. That also translates into the fact that your indemnity is not going to be paid until May or June of the following year. So back to our example of a lower yield and a higher price, we have to recalculate our guarantee because we have a higher fall price than we did the spring. So we take our county expected yield of 204.4 bushels, multiply that by our higher fall price, we now have a guarantee of $1,022. Works just like your RP policy. We now also have to recalculate Farmer John's band of coverage guarantee. So we take that same 200 bushel APH on his farm, multiply it by the $5 fall price, use the 9% band, and we get a $90 per acre coverage. Now, how do we figure the loss? So we've already established that we have a higher expected revenue of $1,022. We know what our actual is because we have 190 bushels times $5 is $950. So we divide the $950 by the 1,022 and get 92.95% of the expected value. You take a 95% ECO policy, subtract the 92.95% of actual production or revenue, you get a 2.05% loss. We now have to calculate how much of that band we have lost. So you divide the 2.05 by the 9% band and you get a 22.77% loss. Multiply that 22.77 times our recalculated band coverage of $90, and Farmer John is going to get an indemnity payment of $20.50 per acre. If you take that $20.50 per acre, add that to our $950 of recalculated actual production, and you will get 95% of the 1,022. In our second example, we have a higher yield and a lower price. So Farmer John, again, has his same inputs of his APH and the spring price. The county yield and price are the same, but now we have a higher yield, 220 bushels per acre, and a lower harvest price. So we don't recalculate the guarantee because the fall price is lower. We don't recalculate his band of coverage because the fall price is lower. But we calculate the harvest revenue, 220 bushels times $3.60 equals $792 of revenue produced this year. Again, we divide that by what our expected revenue was of $858.48, and we get 92.25% of what our expectation was. We go through the same math. We have a 95% policy. We're subtracting the 92.25%, and we have a 2.75% loss. Divide that by our 9% band. We get a 30.55% loss. Do the same math with the indemnity. Calculate that times his $75.60, which was his original coverage guarantee, and you get a loss payment of $23.09. This next slide is where we think this product has extreme value. We're looking at this, as I said before, as an umbrella protection policy over your whole farm. In this scenario, given where we are in spring prices, we feel that this product gives you huge price protection. So in this case, we have an average yield and a lower price. So given the scenario we have today, we feel that we are going to plant more corn acres, and if we use trendline yields and expected yields, we probably will drive price down. So in this example, Farmer John has the same APH, same spring price, same coverage level. Now we're saying we just produce an average crop and prices drop. We're not recalculating anything, but we are extracting the put value out of this policy. So we're going to calculate our harvest revenue, 220 bushels times the fall price of $350 gives us $770. We calculate everything the same, divide our 770 by our beginning or our expected value of 858. That gives you roughly 89% of the expected value. Subtract 89 from your 95% coverage. Divide that by your 9% band, gives you a 59% band loss. Multiply your band loss times your coverage of $75.60. It's going to give you an indemnity payment of $44.60 an acre. As I stated in our last scenario, we're looking at this policy as an umbrella over your whole farm operation. We're looking at it as what is the value of the price protection in this policy. In this chart, you can see that using the 2020 marketing year as an example, had I had 95% put option coverage, I would have had to have done no marketing in that time period where prices were low. I knew that I had 95% of the spring price to fall back on. We could have rode the whole summer and started marketing grain when we came back out of that dip. The same thing is true on soybeans, as illustrated on this chart. 2021, we don't know what that's going to look like. But based on where the numbers are today, we're going to end up with basically a $4 put option as being 95% of our spring price. We think that has extreme value, and it's the cheapest place to buy that is in this policy. When you look at the value of the put option part of this policy, we do some comparison to what we can do on the Board of Trade. So if we buy a $4 put on the Board of Trade on 204 bushels, it's going to roughly cost us $49 an acre. If we look at the put value in an ECO policy and the base policy, it roughly costs us 9 cents a bushel. So for the price protection part of this policy alone, it's $9.17 an acre, as compared to $49 if you're using put options. Now, I'm not saying that an ECO policy costs $9. I'm saying the price/put part of this policy combination is roughly $9 an acre. So when you look at price protection, and when we look at crop insurance, yield may vary from acre to acre, but price hits every acre that you grow. That's why we think this product will change the way that you look at crop insurance. You have a very reasonable price product that can protect your farm operation in 2021. When you look at soybeans, very comparable. You're going to end up with roughly a $10.40 put option, or 95% of the current market price. That same 9 cents a bushel is roughly the cost of the price protection in your base and ECO policy. So roughly $5 an acre as compared to $32 an acre if you do it on the board. Again, price hits every acre. This is an extremely valuable product, and we think it will change the way you look at things. If you have questions about the ECO coverage that we have talked about in this video, or want a quote on farm property and casualty, please contact us at the Excel Group.